how much of the Fed's pivot, or whatever you want to call it, the change in tone, the change in message that we saw from October to this date was because of the market reaction to what the Fed was broadcasting?
I mean, I thought the December meeting myself, I thought it was a step too far. I argued against that move. We did get a bad reaction in financial markets. I think markets started to think we were too hawkish, might cause a recession. You've got this yield curve issue hanging out there with almost inverted, depending on where you look on the yield curve. So I think all of this weighed on the committee and got people to change their tune.
So you saw the sell-off, especially in December, and you thought maybe as a committee, we've gone too far, we need to reel that back in?
Well, you have to ask other people, but I felt like we went too far.
But when you're sitting in that room, did you feel like people were coming around to the idea that maybe you did, to your thinking, that maybe the Fed as a whole stepped too far and you needed to reel that back in?
Well, I made, I think, effective arguments about, global interest rates are still really low. In Japan, the policy rate is still negative. Europe, policy rate is still negative. 10 trillion, on the order of $10 trillion globally at negative nominal rates is sitting out there. So it's a very low interest rate environment. The U.S. has high rates compared to that, so we've done enough here, and we're not seeing the inflation. Still a little bit below target. We missed the target on the low side since 2012. Looks like we might miss the target again on the low side again this year. We really need to pay attention to those kinds of market signals.
This scary scenario of we stayed easy for too long is rearing its head again. We stayed easy for so long, the debt is so big now that we're unable to get back to what should be a normal rate because the debt service is too big. And there's a
let me push back against the normal rate idea.
There's a day of reckoning coming.
Let me push back against the normal rate idea. The safe real rate of return has been declining globally for 30 years. It used to be in the 80s and 90s. When I started my career, is up, 4%, something like that, 5% even. Now it's way down below zero even. So you have to start, that's kind of your starting point where you're doing all our pricing in financial markets. And that thing has come way down to the tune of 500, 600 basis points. And then from there, you want to run your policy and have your interest rates be high or low. And so the idea that we have to get back to this normal interest rate, it is not the 80s or the 90s anymore globally.
Did the chairman talk about that lunch? Did he have with Trump?
Lunch? I thought he had dinner.
Oh, dinner.
It was dinner. It was a steak dinner, no less.
But Joe raises the big question, I think.
Does that get discussed?
What did they say? It wasn't McDonald's. It wasn't Crow, right?
Jim, how do you handle the issue that what the Fed has done is exactly what the president publicly said he wanted the Fed to do?
Yeah, I mean, the idea that there are political factors going in, I think that those are dots that shouldn't be connected. The committee has a mandate to get the inflation rate, keep the inflation rate low and keep employment high. And we try to do the best we can on that. It's a big committee. You've got lots of opinions on the committee. The joint judgment of the committee tends to be very good. And I think we made the right call on this.
So could December have been the committee pushing against political pressure, whereas it would have been seen to have been politically motivated had it not raised rates in December?
I don't think so, but I'll put one thing on the table. We do have our dot plot. The way we do that is on a calendar year basis. People had penciled in December for a rate hike all the way, in August, September timeframe. So by the time you get to December, markets were expecting a rate hike, and we had penciled it in. We kind of said it's coming. So that creates, in my opinion, that puts the committee in a box. The markets were very volatile. You might have wanted to step back at that meeting and not do it, but then because of the dot plot and the SEP, I think we were in a little bit of a box there. So I think that's a bit of an issue, and I'd like to fix that, but we can go into that if you want.
That makes it sound like the Fed is really not that responsive, that it was put into some sort of position where it had to go forward with the hike despite what it saw.
Let me get Jim's view of the world here.
Yeah.
So you had this quarterly process where you're doing these things at quarterly meetings. You can only act 4 times a year under that scenario. I've never liked that. I think it puts the committee out of position and in awkward positions like we were in December. What I argued for at the meeting was that what you could have done is said, well, we're not going to move in December, but we'll keep it on the table for January, and we'll see how everything plays out here. To me, that's how Greenspan would have played this in the older era. And we weren't in a position to do that and not in the mood to do that. But we could have, because we had the press conference at the January meeting, and hopefully we'll be able to play these a little bit better going forward, do this substitution across meetings.
You must have been frustrated given the reaction in the markets that we saw when the Fed did go ahead with it, when you urged them not to, basically.
That's it. I'm one person on a big committee, so I like to put down my point of view as best I can. And
you're a gracious winner, Jim Bullard.
I do trust
a gracious winner.
I do trust the judgment of the committee and the chair. I think on the whole it tends to be very good.